Mohnish, thank you very much for making time to do this, the Mint Equity Master podcast with us. We're super delighted to have you on the show. Uh,
Well, Rahul, pleasure is all mine.
Wonderful. Thank you. Uh, you know, uh, our podcast is more about the individual and the way they've approached situations in life, and from there we draw the lessons. So we'll do the same thing today, if you'll indulge me. So I want to kick it off by starting right from the beginning. If you could spend a few minutes talking about where you grew up, a little bit about your parents, what were your parents, professionally, business wise, and also uh, whether at that point in time, whether there was any investments, discussions, IPO papers, or something doing the rounds in the house. If you can give us a little bit of a background on that.
I was born in Bandra in Mumbai,
I'm
Amchi,
sitting in
Mumbai.
car right now, stone's throw
Okay,
away.
on Linking Road.
Oh wow,
So,
just here.
yeah. So, first 18 years of my life was 10 years in Mumbai, 6 years in Delhi, and 2 years in Dubai. Though it was not in contiguous streams. I
Mhm.
had 2 3 year periods in Delhi in the middle, but Mumbai was the biggest one out of the three. But the other places were also interesting. My father was a, you might call him a quintessential entrepreneur. He was extremely good at identifying what I would call offering gaps. So he was really good at kind of scanning the radar and saying, "Oh, this is a product or service that does not exist, and I think there'll be, a good demand for it." He was also extremely good at starting businesses with zero money. So basically, and in fact, that's a skill I picked up from him. He used to say, you could put me naked on a rock in the middle of nowhere, and I will start a business. And so he had a great ability to identify opportunities, and he had a great ability to basically create something from scratch which didn't exist. And his downfall was that he was a eternal optimist, and he was very aggressive. So when he identified an opportunity, and the business would invariably take off, he would step on the gas with everything he had. And so the common trait in all his businesses was that they were very highly levered. And like, whatever the banks would give him to the max, whatever he'd take all that. And they had no real staying power when the first headwinds came. In my childhood, basically, every 3 or 4 years, my father would go bankrupt. So there would be a great business which would have a very rapid growth, and then it would blow up. And some of these things got pretty large. They got up to like 3 or 400 people, and then blew up. So my parents basically were very poor financial planners. So basically, when times were good, they lived like kings. And when the business went bankrupt, we did not have money for rent. We didn't have money for groceries. It was absolutely, we would hit bottom. So basically, when the business was having difficulty, we were personally having difficulties. So, borrowing from friends and relatives and so on. So there was this kind of constant boom and bust. But my dad would go through the bankruptcy, have nothing left, and then he would find another opportunity. So he started businesses in maybe 10 different industries. In many cases, he started businesses with no prior experience in those industries. For example, one time so the last bankruptcy he had in India was when I was 13 years old. And so just to go back a little bit. So I think after I was about 10 years old, my brother was about 11 years old, we were like the board of directors for my dad. So I remember that we would sit down at night, maybe when I was like 12 years old or something, and the business was in very serious trouble. And we were just trying to figure out how to make it run for one more day. And we would, all the caves are, all the walls are caving in, all the creditors have their knives out, everything is collapsing, right? And in the middle of all that, all we are trying to do is keep it alive for one more day. And then we would meet the next day at night, and we try to figure out how to keep it alive for one more day. And when I was about 16 or so, I used to go on sales calls with my dad. And basically, by the time I was 18, I had finished many, many MBAs. I had finished degrees in business that are not taught in any business school. And in fact, it was a very accidental experience because the human brain. So, one of the quirky things about humans, the brain is the most underdeveloped organ when we are born. The birth canal is too narrow. And so basically, the brain that comes out is almost like premature, you can say. And it's the fastest growing organ in the first 5 years of life. So the neuron connections are going like crazy. And you can see an infant, 1 month old is utterly, dependent with almost no abilities. And then that changes very rapidly. So the brain goes through a very rapid growth in the first 5 years of life. After about the age of 10 or 11, it is optimally set up to specialize. So from the age of 11 to about 20, the neuron connections actually get cut. They are reduced, and there's sections of the brain that are optimally set up to specialize. So that is the only window of time in our entire lifetime, from 11 to 20, when it is the biggest bang for the buck to specialize. Now, in our education systems, what happened is we are forced to be jack of all trades from 11 to 20, or at least 11 to 18, or maybe in India, 11 to 16. So that window basically closes for most humans without really. Now, there are some humans, what happens, like Bill Gates, he starts programming at 11. Okay. Warren Buffett, he bought his first stock at 11. And in my case, if you look at Michelangelo, you look at Leonardo da Vinci, you go back into their lives and you will see there's a lot of activity taking place from 11 to 15, which is helping them specialize. And someone like Bill Gates had probably done more than 10 or 15,000 hours of programming before he was 20. So someone in their 40s who's done the similar amount of work from 20 to 40 cannot match Bill Gates because he did it in a window where things were just optimized. So in my case, it was accidental, where my parents obviously had no clue about all this, that I got a huge education in business while going through this, jack of all trades, stupid education system. But I was learning business on the side and it weighed on our minds because these things were going under, so you have to like, figure out a lot of things. And you really get really good at business when it's facing adversity. I mean, that's when you're like, trying to turn over every rock and whatever. So sorry, go ahead.
I think necessity is the mother of all invention.
Yeah. So my dad basically was. I'll give you an example. For example, at 13, when he went bankrupt, at that time actually for the first time he took a job, and he took a job in Dubai. So he moved to Dubai, basically get some stability for the family. One time he was taking a flight to Dubai from Mumbai, and there was a jeweler sitting next to him on the flight. They didn't know each other, just randomly sitting next to each other. And the jeweler was explaining to my dad how the UAE had these laws where raw gold coming into the country had no duties or tariffs, but finished gold had a 2% duty. And he said that when the 2% duty is assessed on the entire gold finished, the duty on actually the labor content was very high. Because if you just look at it, so he was explaining how if the manufacturing that's done in India of this handcrafted Indian jewelry was done in Dubai, even with elevated labor costs, because of this nuance, there was a widespread. and that there was nobody in the UAE who was manufacturing jewelry in country at that time. So by the time the flight finished, my dad had decided to go into the jewelry business. He had no prior experience in the jewelry business, and to leverage this particular arbitrage. The guy he was with, eventually turned out to be a crook, but he taught my dad the jewelry business. My dad was very smart. He could pick up stuff. So by the time a year or 18 months later, that guy had left with a bunch of gold or whatever, my dad at least understood the business. And that business paid for my college education in the US. So just to give you an example of kind of how he moved. And again, that business went bankrupt when I had about a year and a half left to finish college, because again, it was pumping on all cylinders, it was jamming as aggressively as he could. And there was a downturn, it blew up, and so on. So basically, that was kind of the formative experience in the early years. And I would not trade my parents for any other parents. They were amazing individuals and taught me wonderful things, raised us all very well. So overall, I would not change anything about the whole experience.
Your mother was a housewife. Was she working somewhere?
I'm sorry, your audio, I couldn't hear. Just can you
No.
repeat?
Was your mother working or was she at home?
No, she was at home.
She was at home.
Yeah.
And the other question I had related to this is about investments. Were you all making any investments at all? I know you mentioned that when the times were good, you're not really investing much. There was no
No, so
financial.
my parents, in fact, one of my deep regrets is that I think that by the time I learned about Buffett and Munger and was kind of coming up to speed and all of that, my dad passed away about 2 years after that. So I actually never had a chance to really discuss capital allocation and the Buffett Munger frameworks. And I think he would have absorbed that pretty quickly. And I think it would have changed his trajectory quite a bit. So basically, no, I think what was happening is that when times were good, we were living well, but everything was going back into the business.
Yeah.
So it was basically all eggs in one basket.
Yeah. And so you were studying in the US, you did your graduation, etc. Where did you go next? What did you do next? And where did this whole idea come about? Was it accidental or was it like a planned move that, hey, you know what? I'm going to be really good at picking stocks or making investments?
Yeah. So basically, my degree is in computer engineering, and I
Which
came to the
makes
US as
perfect sense. Perfect sense.
a and actually, I had no idea. People just said computer heart, and I started in computer science. Then there was more math in engineering, so I switched to engineering. And I was on a student visa at the time, and so my first priority was to get a green card. So, and my parents actually were in very bad financial shape at that time, and so the immediate necessity was to get a job, support them, and so on. So I started working in the tech industry, and then I had made up my mind that I had a good degree, I had a good job, and I was going to kind of rise in the corporate world. And I had very specifically decided that I'm never going to be an entrepreneur, mainly because I had seen a lot of trauma in childhood. And I remember my dad was visiting me one time. I'd been working in engineering for a couple of years, and I used to be dressed pretty shabbily. You work in the lab, nobody cares how you dress, whatever. And he sat me down and he said, I have failed. I have failed as a father. He said, you wake up at like 9 a.m., then you roll into work at 10 or 11 a.m., and you dress, with all these torn jeans and whatever. And my dad was always a, perfect dresser, bow tie, suits. He was just immaculate, throughout. So he was one time reading the company newsletter that came home, the company I was working with. And he saw in the newsletter that they were opening an international division. The company was doing about 200 million in sales. They wanted international to bring in 200 million in about 5 or 7 years. So they were going to invest a lot of money growing their product and customer base outside the US. So They had just set up an international group. They were just talking about that in the newsletter. My dad said, this guy, Peter Foos, in this newsletter, I want you to go, I want you to call Peter and I want you to go meet him. And I want you to tell Peter that you want to go work for him. So I told my dad, listen, you know nothing head or tail about what I do, nothing head or tail about this company, nothing head or tail about Peter. He said, I said, Peter's not interested in me. So my dad said, that's okay. I just want you to call Peter. So every day when I'd come home, he would tell me, he would ask me, so did you call Peter? Okay. And I'd say, no. So I said, okay, let me get the old man off my back. I'll call Peter. Peter will tell me to like go fly a kite. And that'll be the end of that. So I call Peter and Peter's really interested to meet me. Okay. So I tell my dad, he again asked me, I said, yeah, I called Peter. He actually wants to meet. He said, great, let's go shopping. Okay. So he said, you can't go meet him the way you dress every day. You're going to, I said, I can't show up to work in a suit and all that, whatever. He said, no, one day when you go meet Peter, you're going to. So he was really excited. We went shopping. He reset my wardrobe. And I went to meet Peter, and Peter gave me a job. And at that time, the engineering stuff was kind of getting a little boring because we had shipped the product, there was no work. So I made the switch from engineering to international marketing. That was a very exhilarating 3 years because the group I joined, which was like maybe 6 people, about 3 years later had 800 people. And we had made a couple of acquisitions overseas, and I was probably 80% of my time traveling all over the world and, doing a mix of engineering and sales and marketing. It was a really exciting time. And I was single, and, like I would be on a business trip to Bangkok and then I'd spend the weekend there, all company paid, everything paid. So after a couple of years, my dad is visiting me again. I'm dressed every day in a suit, blah, blah. So he sits me down and says, it's time to quit. I said, you're the guy who told me to take this job. I took this job. I love this job. It's awesome. And this is just great. Everything is great about it. He said, look, all you're doing is making somebody else rich. You don't see any of the rewards of what you're doing. So I said, have you forgotten my childhood? I don't want the roller coaster ride. So he said, the roller coaster ride is what makes it exciting. And so he was able to convince me to start my first business. And I actually knew how to do that because of all the time in childhood and so on. So I started an IT services company, and I kept my job and the startup till it had enough cash flow where I could quit my job and I would be making more than what they were paying me. And that business did really well. It was growing really fast. It was the early 90s. And accidentally, I think in 94, my wife and I were vacationing in London in 94, and I was looking for something to read on the flight back. And I picked up one of Peter Lynch's books, One Up on Wall Street. And I had never bought a stock before. I'd never made any investments before. I really didn't know head or tail about any of this stuff. But I really enjoyed Lynch's book. So then I looked up and found he has another book. So I read that. And then I was out of Peter Lynch books. There were only 2 books. And I wanted to keep going in this area. But he was talking in the second book about a guy named Warren Buffett.
Beating the street.
Which,
Yeah.
yeah, I read One Up on Wall Street first, and then Beating the Street was the second one. And he was talking about Buffett. I'd never heard about Buffett. And so I started to research Buffett, and I was very lucky. The first couple of biographies on Warren Buffett had just come out, and then that led me to the Berkshire shareholder letters, and that opened up a huge world. And I had a aha moment in '94 when I studied Buffett and the way he invested. And the only kind of professional managers that I knew about was the mutual fund industry. So when I looked at what Buffett was saying about how to invest, and I looked at the way the mutual fund industry functioned, the two were night and day. You know, Buffett says, you have this 20 punch card. In a lifetime, you buy like 20 stocks. Each one is a big decision. And the typical mutual fund has 100 stocks and 80% annual turnover. They're like dancing in and out of stocks all the time. And their results reflected that dancing. So when I looked at all the mutual funds, I would find like 80, 90% of them did worse than the index. And so I had a notion. I said, if somebody just follows Buffett's approach to investing, of just being understanding the business, making a decent bet, sticking to it, understanding intrinsic value, circle of competence, and so on, one should be able to do better than the professionals. So that theory really has no merit till there's some proof or execution behind it. And in 94, I had sold a small portion of my company. After taxes, I had $1 million. And I really didn't need the money. The company was doing well and it was an extra 1 million. First time I had money in the bank. And so I said, okay, I'll take this million. I'll start investing it using Buffett's frameworks. I was going to buy like 10 stocks, 10% bets. And I want to see what happens, and this is my day job. I'm still running my IT company. And in about 5 years, that million has turned into 13 million. And basically it was like a 70% annualized rate of return. Did exceptionally well. So I said, well done, Mohnish. We knew you could do this. And I was probably spending like maybe 15, 20 hours a week on investment research and analysis. And I was spending probably 40 hours, 50 hours a week on my business. And I was getting less and less interested because what had happened with the IT company was it was up to about 150, 170 people. My job had turned into human resource management. I was basically just managing a bunch of political games played by a bunch of vice presidents. And I had no interest in that. So it got to the point where I basically didn't even feel like going to work. And so what I did in 99 is I started a search for a CEO for the company so I could leave the company because I really didn't have any interest in being there. And I decided my first plan was to go work for Warren Buffett. So I wrote him a letter offering my services for free. He wrote back saying thanks, but no thanks. And then my friends, basically, I used to give them stock tips, after I'd bought something and they had done really well. So they came to me and said, listen, we want you to manage money for us. And you tell us to buy something, we buy something and it doubles, we sell it, and then we don't see you and it's all very random. So they wanted to give me money and they said, you manage it. So I set up Pabrai Funds in 99, really as a hobby. For me to invest, it was a total of $1 million between me and 8 friends. And about a year and a half later, we had a 70% year the first year. I had brought in a CEO who had taken over my business. About a couple of months after he started, he said someone wanted to buy it. So we sold the business because he was going to get a new deal and again, another bite at the apple. And so in 2000, I decided, let me not treat the fund as a stepchild. Let's treat it as a real business and try to grow and scale it. So Pabrai Funds, then I started to, pay more attention to it in terms of, adding more investors and assets and so on. And it grew and did really well. So that's kind of how the journey got going.
What a fascinating journey. I have a few questions related to this. One is 99 is a pretty peculiar year to launch a fund because it's on the eve of what would turn out to be one of the biggest crashes we've seen in a long time. The TMT bubble burst in the first quarter of March, April of 2020. And you
Yeah.
still had a very good year.
So basically, the Nasdaq peaked on March 9th, 2020. And when I started investing, almost all my investments were tech investments because that's what I knew well. Okay. And I could probably see the bubble not very much in advance of the others, maybe 3 to 6 months ahead of the others. But by the middle of 99, I was very convinced that this thing was going to end badly. I didn't know when it would end and how it would end. So what I did is I did a complete 180. So Bri Funds launched on July 1st, 99. And what was happening is the day the NASDAQ peaked on March 9th, 2000, was the same day that Berkshire Hathaway hit a multi-year low. So while one portion of the market was very frenzied and going crazy, pets.com and everything else, basic brick and mortar businesses got very cheap. Funeral homes, steel mills, Berkshire Hathaway, and they got like single digit multiples. I bought a funeral home for 2 times earnings. And so people were literally selling basic companies and dumping everything into pets.com, right? So in 99, when the fund started, I completely switched to classic Ben Graham, deep value, which actually I'd never done before then. And first year, we were up 70%, and the NASDAQ started to crash. So from July 1, 99 to June 30th, 2000, I was up. And already in the last 3 months, the NASDAQ was cratering. The NASDAQ it was a crash in slow motion. It took about 2 years when it went from 5,000 to 1,200. So it gradually went down. But basically, from 99 to 2007, Pabrai Funds did 37% a year before fees, no down years. And basically, the disparity between us and the indices was massive. And I wasn't doing anything special. All I was doing is just I was looking for companies which had very stable cash flows and operations, extremely boring, and no one's interested. So I'll give you an example. Like I think in 2004, I ran into this steel company called IPSCO. And IPSCO was trading at about $45 a share. They had $15 a share in cash. They had no debt. And these guys were building the kind of steel they built was tubular steel, kind of like what goes into pipelines. So they had an order book that went out several years, and they had very visible cash flows. They had publicly stated that the next 2 years cash flows were $15 a share each. And so the stock is at 45, there's 15 of cash. If you take the next 2 years cash flow, you're going to have $45 of cash. And the plant and equipment and everything else is free. So it's a very cyclical business. We don't know what the cash flows are after 2 years. But I said, I just want to buy the stock and let's see what happens after 2 years. So a year later, they announced, one more year, we will have $15 a share in cash flow. And by now, the stock is at like 70. And then I was thinking, okay, this is cyclical. Maybe we should, let it go. We made our money and all that. And then it gradually drifted up to about 90. And I was getting ready to sell it. It was a double in less than 2 years. And I woke up one day, there was an announcement that some Swedish company was buying it for 160. So the stock immediately goes to like 155. I don't even wait for the deal to close. We exit and move on. And I don't know why that Swedish company didn't come in 2 years before that, when it was at 45, but this is the way the world works. So it was things like that. It was like there was no one's interested in the steel business and whatever else and so on. So it was just kind of classic Ben Graham mathematical games. And you just go from there.
My memory of March 2020 is, I don't have the dates right, but the Berkshire Hathaway annual letter came out. And he again spoke of, he says the same thing effectively every year, right? And then someone wrote a piece, and I'm sure I have it somewhere in my archives, where someone said Buffett doesn't get it. He's lost it.
Yeah. He was on the cover of Barron's, buy tech Warren, what's up Warren,
Yeah. So, and over time, some of these guys are so smart. Warren Buffett, Munger, you've got to listen to them, because when even someone's like questioning the basic understanding, irrationality is the dominant emotion, and that's when you make a move.
Yeah.
So that's never left me, and it's happened again and again, right? It's happened multiple times in the last 30-35 years. It's a great way to get a signal on what one should be doing. But did you get to buy Berkshire Hathaway then, when it hit its low in the March 2020?
I've never had much Berkshire Hathaway. I've occasionally had it in the funds, but there was so much other stuff that was way more mispriced.
Yeah.
and more interesting. So generally, I was buying, tanker companies and funeral homes,
Old
things.
economy, old economy stuff.
They were very very mispriced. Yeah.
It's amazing, right?
And actually, just to continue the story further, so did very well till 2007, and then the financial crisis I did not see coming. So from 2007 to 2009, the funds went down probably around 65, 67%. And the markets went down probably, 37% or so in that period. So we went down a lot more than the markets did. And I remember in like 2008 and '09, commodities had been crushed, commodity stocks and commodities. And I was selling PE of 3 to buy PE of 2. That's kind of what my trades were. So I remember in 2009, after we bottomed in March 2009, we were up, I think, 140% for the year in 2009. And then gradually that recovery got underway where, we started to get our money back and so on. And one of the things I should have done is probably around 2012 or so, I should have switched back to what I used to do originally, growth investing. So usually the best way to invest is to buy businesses that will, grow over time. That's usually going to be it's just that sometimes you get periods where there's such extreme euphoria where that strategy is not going to work because, you're going to be buying things at 100 times earnings or whatever, and it's just not going to work very well. What I should have done is, but by that time, so I'd been running this Graham playbook now for 13 years. And the playbook had worked really well. So it was just very comfortable, right? So I just kind of continued. And I did not actually make the switch over to back to the growth stocks, etc., till around 2020. So I basically, I would say I was probably 8 years or so behind. Now, the thing is that there were things I was doing which still worked really well. So, for example, in 2012, I made an investment in a company called Fiat Chrysler, and that was a huge multi-bagger we made over the years. But inside Fiat Chrysler, which at that time had a $5 billion market cap, so in 2012, Fiat Chrysler has a $5 billion market cap and 135 billion in revenue. Okay, so it's trading at like less than 4 times, less than like 4% of revenue. Okay, and they had brought in a rock star CEO, and I could see that a lot of things would change. Inside Fiat Chrysler, a piece I didn't pay much attention to was 80% of Ferrari. So they owned 80% of Ferrari. So just to give you a sense, I didn't capture all of it, but basically, in effect, about 1/3 of that market cap was attributed to Ferrari. So out of the 5 billion, about 1.5 billion was attributed to Ferrari. Ferrari is now about a 50 billion market cap by itself. And then Fiat is also a lot of dividends and such and gone. So what I'm saying is that even though I didn't switch to growth investing till later, there were bets like Fiat Chrysler, bets in India like Rain Industries and so on, which did really well, huge multi-baggers. And then more recently, I made the switch, but I made the switch somewhat carefully because we still had in 22 a lot of euphoria. The bubble popped. We again got to crazy valuations. And so that's where we are today.
I want to ask you a question about the 2007 and 2009 period. I'm sure you thought about it a lot. Why do you think you missed it? That there is a euphoria happening and you could get caught on it?
Well, I mean, I think that in that period of 7 to 9, there were a very small number of humans, you can count on probably fingers of one hand, who actually saw the whole bubble. You've seen the movie The Big Short. And, just to give you a side story about the bubble, Michael Burry in The Big Short. So I know that God loves me, and I'll give you some evidence of why God loves me. So in 2008, I'm making a trip to San Jose, California. Michael Burry's fund, and Michael Burry is based in San Jose, California. And I don't know him, but I know of him. So I contact him and say, hey, Michael, you don't know me, but I'm a fund manager and I'm going to be in San Jose, and do you want to grab coffee? He says, yeah, just come by my office. Okay. So this is like, October of 2008. Okay. And I go to Michael Burry's office. And you've seen the guy playing the drums and all. So I I I'm I go to Michael Burry's office, and he's got these huge stacks of paper. And he doesn't even like, say hello, welcome, or any of that. He launches straight into CDSs. He says, do you know what a credit default swap is? I said, no, I have no idea. And I'm not even looking to know what it is. I'm not really interested. Then he goes into this huge detailed drill down with me on CDSs and CDS squared, and the tranches, and how to short it, and how real estate's going to blow up, and everything's going to blow up, and the whole Western world is going to blow up, and this is the way you play it. Okay. So now all God could do is he could take the horse to the water. Okay. He took the horse to the epicenter of the best lake. Okay. The horse was too dumb to drink. Okay. So the horse was taken to the water, but the horse did not drink. Okay. And so I came out of Burry's office saying, okay, that was weird. What the hell? We're gonna kind of move on. And of course, then exactly what he was saying proceeds to happen, and so it was a kind of a very interesting experience. Yeah. So I did not see the downturn being as severe as it ended up being. I just my way of investing is I really don't spend any time on macro. I'm focused on particular businesses, where those businesses might be growing, going, and that itself is a complicated thing. Figuring out the future of one business is complicated. Figuring out the future of an economy, there's just a few humans that are gifted enough to do that. I'm not one of them. So yeah, I mean, I think the I would say that I was able to see the 2000 bubble mainly because I had made some private investments in 98, 99, which were in effect participating in the bubble, and those had already blown up. So by the time the fund started, I had already seen the movie on the private markets. The public markets had not fully woken up to the fact that this whole thing was a pack of cards. So I'm not going to be a guy who's going to be able to see, I would say that even Buffett and Munger say that sometimes things are obvious and you can call it. I mean, I would say, bubble in crypto, we can call it, but you might even say a bubble in snowflake and things like that. You can call some of those. But for the most part, usually you don't get these extremely clear signals when bubbles are underway.
On the 2020 piece, this is a question I ask most of my guests. When did you first hear of this COVID, and how did you think through it, what you should do, and what did you actually end up doing?
Yeah, COVID was another one where I think I did not really understand the severity of COVID. So if you look at someone like Bill Ackman, he really got it. He got it really well in terms of COVID and what was going to happen.
He created a whole controversy around it, but
Yeah. But
that's another matter.
yeah, so I think when COVID was when the first news of COVID was hitting, I just thought, okay, this will be something where we might have a few weeks of down, whatever, the virus will die out in the population, and eventually we'll have a vaccine. I did not expect anything spectacular out of it. And actually, when they deliberately shut down the whole economy, that kind of blew my mind. I said this is worse than 08, 09, because 08, 09, we're not deliberately trying to, I mean, the shutdown of the US economy and global economy on purpose is unprecedented. It's never happened. I mean, we had the We had the Spanish flu, 100 years ago. No one shut down anything at that time. And so it was not within, my realm of ability to think that humans are going to deliberately shut down an entire economy. That just blew my mind. And so I think as COVID was unfolding, I was as surprised as anyone else. And I was trying my best to basically try to make sure that the businesses that we owned were not going to get washed away. So, in general, one of the things to remember about business, and I saw this with my dad when I was growing up, is businesses are very fragile. Almost all businesses are very fragile. I mean, if a business loses revenue for a month, something like 95% won't be around after that. So the mortality rate, it's like cutting off oxygen. Bill Gates took the view very early in Microsoft that he wanted Microsoft to have enough cash so it could run for 2 years with no revenue. Okay. And Microsoft built a cash reserve that matched that. 99% of businesses don't have any ability to do. They just don't have the favorable economics to ever generate that kind of cash or have that kind of staying power. So when you have something like COVID, when you're shutting down things and you're not allowing a business to get revenue, I mean, airlines, hotels, restaurants, these were like immediate casualties. And but then, and what saved a lot of them was this incredible amounts of government support. But if we didn't have that support, I mean, I think the economy even today would be in tatters. So the the policy response was exceptional, really mind blowing actually. But someone like me, I'm no good at these things.
If I may offer a view on this, a lot of people believe they call the COVID trade right. And I believe they were just plain lucky because no one knew how it's going to turn out. So
Right.
if they went out and in and they thought we timed it, it's pure fluke. And I remember Munger gave a statement because I think Buffett, there was a statement from Buffett very quickly that he'll not be speaking till the AGM. So
Hmm.
there was no need to wait for Buffett to speak. But Munger, I think, did a call or he spoke to CNBC, I don't recollect. And he said, it if we came out on the other side of this crisis with more cash than we have now, then that's the great scenario. Or something to that effect. Basically placed utmost importance on having cash on the balance sheet, like the point you're
Hmm.
making, right?
Sure.
Yeah. And he has the
Yeah,
wisdom.
Berkshire is really built. So just to give you an example, Berkshire's cash is not in any bank.
I know.
Okay.
I have a screenshot of that.
Yeah.
in in
They've
April.
they've never had they've never had the cash in banks because Warren has had a perspective that even JP Morgan basically, it's not safe. His perspective is he wants to make sure the cash is absolutely and certainly there. He's not trying to maximize the yield on it. So it all sits in very short-term treasuries.
Short-term treasuries. So
Yeah.
I actually have a April 2020 snapshot of the presentation he made on the 1st of May,
Yeah,
actually.
yeah, yeah, yeah,
I think it was $107 billion of cash, or what is the amount? Like crazy amount of
yeah,
money, all
yeah.
in short-term treasury bills. And I'm
Yes.
like, oh my God, that's the solution for everyone. Don't get
And
into
they've been running like that for 50 years,
it's amazing.
you know.
Yeah.
So
Okay. Moving on. Do you recollect which was your first investment that you made? First stock?
well, the very first stocks I bought, there's two answers to that. I think some of your audience might care about some of the stocks I bought in India. So in the US, they were tech investments, and they were tech investments mainly in software companies because I was very familiar with them. So we were doing a lot of services for relational databases, Sybase, Oracle, and so on. So I knew those businesses well. I knew what their growth engines were. So we were generally invested in those types of things. But in towards the end of 94, early 95, I opened an account with Kotak in India. And at that time, there was no DMAT. There was no Kotak Bank. And actually, my banking, which Kotak introduced me to, was Union Bank of India. So they said, you're going to transfer funds to Union Bank. Then Union Bank will give it to our securities trading arm. We'll buy the stuff and custody it. And then when we sell it, when you instruct us, we'll send it back to Union Bank and they can send it to you in dollars. So I remember I didn't put much. I had about $1 million with me. I only invested 1% of that in India, actually 2%, about $20,000. Okay. And half of that, $10,000, I put into Satyam computers. And this was probably about 10 years before anything was wrong with Satyam. Satyam was a perfectly normal company at that time. All the books and everything were clean and such. And I knew the business well because I used to meet them. They were trying to do business with me. Their biz dev teams would meet me. And I could see how they were growing in the US and all of that. It was, growing at about 70, 80% a year. But if you remember the early 90s in India, mid 90s, Satyam's market cap was less than the value of their Hyderabad real estate. So just the office space and all that they had, there was no value actually being ascribed to a business that was growing about 80% a year with high margins. And I remember the Kotak analyst gave me a report that Kotak had done on Satyam. I looked at the report. I said, "This is total nonsense. You don't even understand what the business is all about." I said, "You're not even like the stock was at 40 rupees, and she had a target of 55 rupees. Okay, and the Hyderabad real estate was something like 70 rupees a share, and it was making something like 10 rupees a share, growing 40, 50%, 60% a year." So anyway, I put $10,000 into Satyam, and then when the bubble, my so I bought four stocks in India at that time. I bought Satyam, Kotak, Blue Dart, and Skypack Courier. Okay, and basically I was only going to buy Satyam, Kotak, and Blue Dart, and my thesis on Blue Dart and Skypack was very simple, that the Indian postal system was useless. And if you wanted to get a package from anywhere to anywhere, you had to use private couriers. And there were two listed companies at that time. There was Blue Dart and Skypack. And so I said, as the Indian economy grows, these two are huge beneficiaries of that. As it turned out, Skypack went nowhere, eventually went to zero. It basically disappeared for the most part. And by the by 99, actually I remember in January 2000, so I got physical share certificates of all these stocks. They're kind of falling apart with all these signatures and stuff on them. I just stuck them at the bottom of my desk drawer. I said, never need to open this drawer. We can keep this forever. I noticed that in January 2000, Satyam is trading at like 6,000 rupees a share from 40 rupees. It's gone up 150x. And I told some relatives of mine, buys Satyam and so on. Their whole day is to start in the morning by looking at the newspaper. What is happening? And I told them, listen, I'm going to sell Satyam because when I look at the math, there's no way to justify this valuation. They said, no, Mohnish, you don't understand the business. This company is going to go to 50,000 rupees a share. Okay, it's going to keep going. Okay, they're trying to explain the IT business to me. So anyway, I was also concerned because I look at these share certificates that I had for Satyam. They're like pieces of paper that are like falling apart. So I said, I don't even know if I send it to India, these are fake or real or what. And I don't trust the Indian government will actually allow me to repatriate. I gave them 10,000. I'll be pulling out 1.5 million on Satyam alone. Forget the other stocks. I said, I don't think they'll let me even pull the money back. So I sent all the shares to Kotak. I said, sell all the shares. Okay. They sold the shares and I got like some 1.4 million in proceeds. So then I said, move it to Union Bank. Okay. And I told the Union Bank, convert it to dollars and wire it to me. So the bank manager says to me, Mr. Pabrai, it's near the end of the month. It will really make me look good if I do the wire like on the second or third. It was like the 27th. I said, please be happy. Wire it on the third, no problem. Okay. And on the third, the money is in my US account. No taxes, no nothing. Everything's fine, all done. I said, wow, this works. And then, Blue Dart, Skypack, and Kotak for 5 years had done nothing. They were just sitting flat. And one of the most stupid things I did was I said, okay, like I told you, God loves me. I said, God loves me, but I don't think he loves me so much. I said, he gave me 20,000 rupees in dollars in India, became 1.4 million. I said, these others are still sitting at 10,000. So fine, just close the positions, move on. So I sent all those shares to India and I told Kotak, sell all these shares. And again, I got my $10,000 back. Actually, God loved me more if I had just paid attention. So Kotak went up about 500x from there. So I had put only about $2,500 into Kotak. But anything at 500x is a big number. And Blue Dart went up a similar amount, 300-400x. And I remember what happened is that they sent me one share certificate back, 100 shares of Blue Dart. And they said, this is a fake certificate. So I said, Mr. Kotak, you are the ones who bought these shares from me. If it is fake, you are responsible. They said, no, we have no such responsibility. This is your problem. So they don't have the same liability law like the US does. So they send me these 100 shares. And the 100 shares sat in my drawer for like 15 years. And every time I'd look at the shares, I'd say, yeah, mere ko fake nahi lag raha hai. I don't think this is fake. So by that time, I had started investing in India and I had a relationship with Kotak. They are our custodians in India. And I told the thing, I said, I didn't tell him it's fake or anything. I said, look, I have 100 shares of Blue Dart and I would like to sell them. They said, look, we need to demat it and all that. We need to open an account and all that. So I said, okay, let's go through the process. So I went through the process. They sold the shares. It actually wasn't fake. And I got I think about 8 or 9 lakhs for that 100 shares. Okay, which was like a 3 or 400x, but it was a small piece of the pie. And the big lesson I got from all of that is that, when you find yourself in the happy situation of the ownership of the fraction of a great business, just like Munger says, just sit on your ass. There's nothing else to do. So there was no reason for me to sell those things. Even now, we look at investor like Rakesh Jhunjhunwala, right? I mean, great investor, passed away last year. He had a total of $400 when he was 25 years old and he started investing. He's a chartered accountant. And he passed away with 5.8 billion. He never managed outside money. And he started Asaka Air, but none of the money came from businesses he started. All of this was from passive investing. And if you ignore everything Rakesh did, so in 2003, he put about 4% of his net worth into Titan, right? And he just kept it. And that 4%, which was only about $3.4 million at that time that he put into Titan, with dividends approaches more than 2 billion. So even if Rakesh was, everything else went to zero, he was useless at everything else. The only thing he had to get right was the Titan purchase. And more importantly, the decision to hold. That's it. So it's a very forgiving business.
When I'm listening to you and you're narrating these stories, and you have all the humility. There's all factors playing into your decisions. But you talk about Graham a little bit, the Graham approach. You talk about how you pick stocks. You spend all those hours. So if you were to, so I don't want you to explain us your thought process. There's too much for someone to absorb in this podcast. Can you sort of talk to us about two, three, four things which are like really the key things one should look at to minimize the chance of going wrong, maybe in a stock picking decision.
Yeah. So I think the best way to approach investing is what I would call anomaly-based investing.
Okay.
So basically, we are in the business of looking at anomalies. We are in the business of looking at things that make no sense. And because we are in auction driven markets, like what I saw with Satyam in 95, right? It just made no sense on any metric that it should be priced like that. So, like, for example, a few years back, I started making trips to Turkey. And Turkey is, even now, I mean, last year, the Turkish market was up like 120% in dollars. It had a huge year. But even after going up that much, it is one of the cheapest markets in the world. Everyone and their brother has exited Turkey. No one has any interest in Turkey. The inflation rate is 80%. In 2019, I visited this company in Turkey where the market cap was $16 million, 1 6, and the liquidation value was 800 million. Okay, so and the liquidation value was one of the easiest things to figure out. So this company has 12 million square feet of prime warehouse space, which is 99% leased, inflation index leases to people like IKEA, Amazon, Carrefour, Mercedes, Toyota, DuPont, etc. Okay, like pristine client list. And to build a warehouse in Turkey, on average, it costs $80 a square foot. So up $80 low, 12 million square feet low, that's $960 million. There was 200 million of debt on their books. It's worth 760 million. The market cap is 16 million. Okay. So I remember my Turkish friend, I had him take me to businesses that he owned. I said, I only want to see businesses that are already in your portfolio. Don't take me to some company you have not invested. So he owned this company. So I asked him, is it a fraud? I said, so he said, no. I mean, while we were driving to meet the owners of the business, he said, no, it's good guys running it. And I met the father and son who run the business. They came across as perfectly honest, smart business people to me, really smart actually. And not only was the value there, then I spent an afternoon visiting all the warehouses and all. And then I saw $16 million when I tried to buy it, there'll be no stock available. Okay. But because Turkey is a market filled with gamblers and the trading volumes are extremely high, people basically buy stocks at 10 o'clock and they sell at 3 o'clock. Okay. Their holding period, that's it. They don't even hold overnight. Okay. It's a gambling den. So Buffett has a quote. He's saying the stock market is a mechanism to transfer wealth from the active to the inactive. Okay. Could not be truer in Turkey. So I started buying the shares, and for about less than $8 million, I got 1/3 of the company. Okay. So now, at the time when I was buying the shares, it was 5 lira to $1. Today, it is 19 lira to $1. The lira has collapsed. Okay. In dollars, the market cap has gone from 16 million to 350 million in the last 4 years. Okay. Now, what has happened to liquidation value? I was just in Turkey for 2 weeks. It's at least 1.5 billion now. Rents have gone up a lot. Building material prices have gone up. All these things have gone up. So the the price has moved up, but the value and they are very smart capital allocators. They have done a bunch of smart things and they've increased the value. So even after we've had this big run up, we still have something that is trading at like 1/4 of what I think is. And the thing is, they will keep increasing the value of the business. So all these years of all these arrows in the back that I've taken, what I've learned is this company in Turkey, we just have to do one thing. which is never, ever sell it. Just it's very boring. It does nothing. It just sits there. We are happy to let it sit there. And it doesn't matter what the lira does, because cement prices go up and steel prices go up and concrete prices go up and land prices go up and rents go up. And so it is automatically inflation indexed. And in Turkey, there's one business after another like this. So I'll give you another example, which I think I just kind of gives you a example of. So when you say, when people are trying to invest, we have a company in India called Varun Beverages. Okay. And Varun is the Pepsi bottler for most of India. Right? I mean, I think other than Andhra and Kashmir, they have the rest of India. Varun, I think last time I looked, the market cap is about like $11 billion. Okay. They their volume last year was a little less than 700 million cases. So just remember that 700 million cases and 11 billion. And it's growing, I mean, it's a great business and it'll grow a lot. There is a Coke bottler in Turkey, which is bottling for Coke, but it's not just bottling in Turkey. It's bottling in about a dozen countries where they have the exclusive rights for the whole country. One of the countries they have the exclusive rights to bottle is Pakistan. Okay. So this company in Turkey has the exclusive bottling rights in Pakistan. In Pakistan, 51% of the Coke bottler is owned by the Coca-Cola company in Atlanta, and 49% is owned by this Turkish company. Okay. Coca-Cola Enterprises in Atlanta sold, recently agreed to sell the 51% to this Turkish company for $300 million. So basically, the Pakistan bottler was valued at 600 million. Half was sold for 300 million. In Pakistan, the Coke bottler volume is 400 million cases a year. Okay. Varun is little under 700 million. So let's double it. So 600 million is the value for 400 million cases, 1.2 billion for 800 million cases. Okay. There may be some differences in the growth rate, but the bottler in Pakistan is sitting at 10% of the valuation of the bottler in India. And Coke is a better brand. So between Coke and Pepsi, people will go for Coke. So it's actually the more dominant, better brand. So that Coke bottler in Turkey, they have operations in all these countries, including Turkey. So the market cap of that business, which is about 1.6 billion cases a year, is 2.8 billion. It is 1/4 of the value of Varun Beverages at almost 3 times the size. Right? So anomaly. It's an anomaly. So one of three things is true. Varun is overvalued, or the Coke bottler is undervalued, or a combination of the two. Right? And when we can look at cash flows, we can look at many other things. But the thing is that even in Pakistan and in India, the per capita consumption of Coke and Pepsi is extremely low. If we fast forward 10 years or 20 years, the per capita numbers will go up a lot. The population will go up. All of those numbers will change. So in both places, it's a good business. Varun may even grow faster because Pakistan's having all kinds of issues. But 10 to 1 difference in value, one is trading at 50 times trailing earnings. The other is trading at 9 times trailing earnings. So what we are looking for in investing is things that when you look at them, you say, you are astonished. Okay. If you don't get astonished when you look at a stock about something, just pass. Wait for something else that astonishes you. Because in auction driven markets, you will find astonishing things. It will not happen every day, every week, every year, but you only need one Titan. You only need one Reysas or one Coke bottler. You don't need too many things. One Blue Dart. Just Focus on the astonishing.
I love the way you put that. You mentioned that you quoted Charlie Munger, just sit on your ass after you bought the stock, right? But there does come a time sometimes when you have to sell a stock. So when and what sort of do you look for?
So selling is a lot harder than buying.
I've heard that
I
before
have
on this
made
podcast.
I have made many, many more selling mistakes
Mhm.
than buying mistakes. Okay. So what I have learned after all these arrows in the back on selling is basically be extremely reluctant to sell. Okay. So if a company's valuation is fully priced, it's not time to sell. If it's overpriced, it's still not time to sell. It has to be absolutely and totally egregious, where you cannot come up with any way, cash flows and the valuation, to bridge the two with even heroic assumptions. So basically, a business is worth the sum of future cash it'll produce from now till judgment day, discounted back. If some company is earning $1 million a year and the valuation is 200 million, you bought it for 8 million, now it's 200 million. It probably should not have been sold at even 30 million or 40 million or 50 million, because that is within the realm of reason. Past 100 million, 150 million, you can let it go. So, but basically it has to be at an extreme. So we need to be basically extremely averse to selling. Now, if we have bought something where we have very clear evidence the business is low quality, the people are low quality, the competition is intense, absolutely you can. So we have to, the important thing with selling is separate the signal from the noise. So when you are convinced you have real signal and you don't have noise, a company can have a bad quarter, 2 quarters, 3 quarters, that's noise. But if there is integrity of management in question, if there is competitors eating their lunch and they've kind of lost their competitive advantage, they're no longer the low cost producer and all these things. So when things become secular and you're convinced they become secular, so one thing about selling is you don't need to rush. You can be sloppy on the selling. So if you find something is overvalued, whatever, take your time. Take your time to convince yourself that it's truly egregious. If it's just simply overvalued, don't do anything.
Good advice. Because I
It's
mean,
a
you
great way. It's a great way to make your broker starve.
do that. Make them start. Okay. I have to. I know we don't have much time, and I have a bunch of questions I have to cover with you. What are your thoughts on investing beyond stocks? Do you do gold? Do you do property? Do you do debt? Is there anything else that comes to mind that you think people should look at and try and study and get good at and make invest some money?
Yeah. So there's one thing very unusual about the stock market, which does not exist in other markets. The stock markets are auction driven. It's buyers and sellers coming together in a marketplace and setting prices. Auction driven markets have a very specific peculiarity. They get depressed at times and they get euphoric at times. And if I just, you know, randomly throw a dart at any stock listed on the Bombay Stock Exchange, and I look at the 52-week range on that, it will be like 60 to 130
Mm-hmm.
or 100 to 250.
Mm-hmm.
Just any stock, even if you look at Reliance
Mm-hmm.
or any blue chip stock, you'll see a pretty wide range between the 52-week low and the 52-week high. Now, let's say I have a broker friend of mine, a real estate broker friend of mine, and I own an apartment in Mumbai, okay, in Khar. And I tell my broker friend, listen, I'm going to call you sometimes. Just tell me what my flat is worth. So he said, yeah, sure, no problem. So you call him on January 1st. He said, kitna daam hai? What's my flat worth? He says, your flat is worth 6 crores. You're feeling really good. I said, okay, thank you. Then you call him the next day. What's my flat worth? He said, it's worth 6 crores. Then you call him the third day. He says, listen, idiot, it's still worth 6 crores. Okay. And because he's your friend, he tolerates you. He tolerates every day this stupid call you make to him. And every day just write down the price he gives you. Finally, after 30 days, he tells you, oh, thoda, there's some movement. It is 6.1 crores. Okay. So you write down the 6.1. You keep calling him. When you do the whole analysis for the whole year, price of your flat has varied between 6 and 7 crores for the whole year at the most. Okay. It has not gone to 3 crores to 9 crores. But if that flat was a listed company, sitting inside a listed company, it would be between 3 and 9 crores. So just the taking the same asset and converting it into pieces of paper and shares and all that causes this attenuation. So when we look at non-auction driven markets or non-auction driven assets, so let's say, for example, I'm a private equity investor. I'm buying and selling whole businesses. What's going to happen is I'm going to be facing an intelligent seller. So it's an intelligent buyer facing an intelligent seller. Unless there are like crazy things like COVID or something going on, you will end up with an intelligent price. Otherwise, there'll be no deal. So when you have an intelligent buyer, now, when I was looking at this company in Turkey, which was 16 million market cap, and I told the owners of the business, I'll give you 25 million. Please give me the whole business. They would have just laughed me out of their office. Okay. But in the market, it's available. The whole business cannot be bought for 25 million, but 10%, 20%, 30% can be bought at that price. Okay. So the only time I have that doing something other than auction driven markets, because I think this particular nuance of publicly traded stock exchanges, all of that gives us a way to invest, which is not available in all other asset classes. Okay. It's not available in gold. It's not available in buying whole businesses. The one time I used this knowledge for other purposes was in the 90s when I was investing in tech. I used to notice that some software companies were trading at very high multiples. Like I knew they were growing a lot, but the trailing PE was more than 100. So the company is growing 30, 40%. Maybe it's undervalued, possible. Okay, but I can't bring myself to pay 100 times trailing earnings. But what I took that as a signal to mean is that it has high growth. So what I did is, like, there was a company called PeopleSoft, HR software. It required a lot of customization to implement in Fortune 500 companies. I decided I will set up a PeopleSoft practice only because I saw that the valuation is so high. Now, I don't even know how to spell PeopleSoft. So to do a PeopleSoft practice, I need to have a practice leader. And a practice leader at that time would cost like 250,000, 300,000. So I decided in my business, I'll take a chance. I said 300,000, we can take a bet. If it doesn't go, we'll see. So I placed an ad for a PeopleSoft practice leader. And within a few days, I got connected to a guy and he looked exceptional. Great guy, Paul Yates. And Paul Yates basically, we gave him like a 250,000 base salary and some upside, whatever. And he was going to start in 2 weeks. Okay. Now, when he starts with my company, I have no business in PeopleSoft. On day one, it's going to be burning 20, 25,000 a month. So 1 week before he starts, Paul Yates calls me and says, the client where I'm working is asking if my new employer will give me to them on a consulting basis to continue working on. So I said, Paul, what would they be paying? He said, they'll be paying about $3,000 a day. Okay. So I said, Paul, tell them yes. Okay. So now Paul has not started with me. Okay. Every month the billing is going to be 60,000. Okay. And in a year it'll be 700,000. Like expense is 300,000. So I said, PeopleSoft, what stock I saw is already giving me more than, I mean, if I look at the actual amount invested in the PeopleSoft practice, it was like $1,000 for an ad. Okay. I've only invested $1,000, which I will make back on the first day that he starts working. Okay. And his payroll will be paid later. I'm not even paying the payroll till like he's worked. In the meantime, I already billed the client, collected. Then after a week, Paul calls me again. He says, the client wants me to manage a team of about a dozen developers. And he's asking me if we can provide the team, okay, of 12 PeopleSoft developers. So I said, Paul, do you know PeopleSoft developers? He said, I'm the president of the user group in Chicago. So I said, do you know? He said, yeah, I know a dozen guys who I can bring. So I said, what will they be paying for each of these guys? He said, about $2,000 a day each. I said, tell them yes. Okay. So we hired these dozen people for 100, 150,000 each. And they all came to work too. So what I realized is that better than investing in the stock market is just look at the highest PE software company which needs services and start that service practice because it's telling you the growth is very high. And then I started doing that. So then we set up a business objects practice. Okay. And so suddenly the IT business is on steroids. Okay, because of this stuff. So that's the only time when I took data from an auction-driven market. And I didn't invest in those companies, but we made more by not investing. So that was the only time when I kind of used it in a weird way. But I would say that, one of the things about life is that you want to specialize. You want to be an inch wide and a mile deep. Okay. So we have a mousetrap. We have auction-driven markets. We don't need to go hunting in other less favorable pastures.
This PeopleSoft story that you tell us. It's like your father finding opportunity gaps. You found an opportunity.
Yeah.
You know,
But I found the gap because I was an investor.
investor. Yeah.
I'm looking at, I couldn't buy, I knew the company was great. I knew the stock was great, but I couldn't buy the stock. I just couldn't do that.
Fascinating. Fascinating. Tough question. How do you have kids?
Pardon?
You have kids?
Yeah,
I'm
I
not
have two daughters.
two daughters. How do you teach them about money? And do they really listen to you? Or is it dad's dad, right? Do they actually sit down with you and try and absorb all your life learnings on investing and how to manage money?
Yeah, actually, so I'll give you an answer because it's worked out beautifully. So I think about 25 years ago, there was this guy. I was in this group in YPO, and this guy had come to talk to us, Bill Harlow. And Bill had basically been part of a buyout of a chemical company from his employer. And eventually that got sold. And, he ended up with like 60, $70 million. He did really well. And he had these, teenage kids, whatever. And what he did was when they were approaching 18, he walked them into Goldman Sachs, opened accounts for them, and put $6 million in their account. And he said, this money is your money. You have full control of this at 18 to do anything you want with it. You can buy Ferraris, you can buy drugs, you can use it for education, whatever you want. And he told them that the reason I'm giving you this money and the reason I'm giving you it at 18, because I don't want you to make career choices based on what pays the most or based on what is people are saying you should do this or you should do that. I would like you to make career choices based on what you are most passionate about. So you have enough money to live a comfortable life, even if you have a profession which doesn't pay very well. And when Bill Harlow came to talk to us, his kids were already in their 30s. So he said one guy is a postdoc. I mean, he did a PhD in physics, and then he went to teach physics in high school. He wanted to teach high school kids. So he says the high school physics teacher that doesn't get paid much, but he lives in a $2 million home. Okay. And he loves his life. And he said the second son did a master's in architecture. He has an architectural firm and doing fine. So he said that basically he did not want to set it up so that the money was dribbling out to them at 30 or 35 or 40. So an inheritance is only really relevant to the person receiving it if it comes very early in life. Later in life, it really has no meaning. We really can't do a whole lot with it. What I had done with my daughters is when I heard this story, I like the story in the US, we have this law, UGMA accounts, Unified Gift to Minors Act. So we can give $15,000 a year. It used to be about $10,000 a year, each parent to each kid or anyone actually want to. And it's tax free. And I set up these accounts for them. And I used to invest the money in like 3, 4 stocks in these accounts. And the way the UGMA account works is at 18, they get full control, just like what Bill Harlow did. And what happened with these accounts, which we were putting like 20, 30,000 a year in, is that they've done really well with the investments. And it was a solid 7-figure sum in both their accounts. And when they were about 12 or 13 years old, I had sat them down and I explained to them that this account is there. And I also explained to them that beyond this account, nothing else is coming to them. And it's a sizable amount. I said, even if we are not doing well, your college is covered. And exactly what Bill Harlow told his kids, I told my kids, which is basically pick professions based on your passions. Don't look at what is the flavor of the day or what people are saying or what will be good to talk about, any of those things. Actually, it worked out beautifully. So my younger daughter, she's going to finish her PhD in psychology in another, I think, year and a half. And she wants to be a therapist. And she actually, for a PhD, she wanted to support herself. So she never bothered with the money or whatever else. The older one basically now has started an investment fund. I actually never talked to either of my kids ever about becoming an investor. I always told them, do what you love. So it's not like the apple didn't fall far from the tree, it fell directly under the tree. Okay. And she actually has very good instincts and raising money and doing well. And so I think that will work out well. So basically, I think the thing is that as parents, we have 18 years to transfer values. If we have not transferred values in that period of time, you can give them nothing and you still have a problem. And on the other hand, if the values are transferred, then the money is actually going to end up being a huge positive. So their friends, all their friends have pursued all these STEM degrees and, whatever else, like, what is going to be hot and what is whatever. And both of them really never went down that path. The degrees they went to, the schools they went to, they just looked at what they were interested in and they just went down that path, which I think was excellent.
I find that very fascinating. I thought you're going to go in some other direction when you spoke about the Bill Harlow story, but it's a complete revelation. Thank you for sharing that. I've got two quick questions I have to
Sure.
get. I'm going to keep the last one about giving money. That's the most critical question I have to get to. But before that, talk to us a little bit about reading and multidisciplinary reading, and give our listeners, viewers, some advice on how broad should it be, how global should it be, how they can use that reading process to become better versions of themselves.
Yeah. So, I'm buying books all the time, different, I read something, some guy recommend some books, whatever else, and or some podcasts, whatever. Probably more than half the books in my library I've not read yet. Okay, so there's a large amount that I have not yet gotten to, and a lot of books that I pick up to read, I don't finish. They just don't appeal to me. Whatever. What I'm looking for is I just go through my library looking for something that is interesting to me at the time. And the book has to really draw me in the first 10, 20 pages. If I don't really get drawn in, I will just move to something else. And but it's a very magical feeling when you're reading something and it really draws you in. And investing is a very broad discipline. The kinds of things that affect the future of a business is just a huge broad array of factors. So understanding human psychology, understanding nuances of what type of business is likely to do well, have staying power, all these things. So you could be reading a book on, some political leader, or you could be reading a book on health, or you could be reading a book on some business biography. All knowledge is cumulative. So my objective in reading, the most important objective is I have to be having fun. I have to be having fun. I have to be enjoying what I'm reading. Just like I try to enjoy my day. I work on things that are interesting to me. I don't believe in retirement. I will never retire. I could have retired and never worked after I was about 33 years old. From 33 till now, there was no reason for me to work for money, but it would have been a terrible life, a useless life. So basically, every day I choose to do the things that I want to do. And the reading is also a choice. And so different things come up. I am very biased towards business biographies. That's my favorite genre, but I'm reading a lot of other things as well. But, like recently, I read a book on the Munjals, Hero Honda, right? And it was written by one of the kids. And it was a great read. I think just that journey that they took, it was one of the things I learned, which was a revelation to me, is we think bicycles are very low tech. The idea with the Munjals was that here's this multinational Japanese conglomerate, Honda. They bypass all the main large Indian conglomerates when they're looking for a partner, and they partner with a bicycle company, right? That's just flies in the face of logic or rational anything. They would have met the Tatas, they would have met all these players, they bypass all of them. And what I learned when I read that book is that a bicycle is actually not that simple. When they broke down all the different parts, there's a lot of specialization. We take it for granted because it's so mature and there's so much supply chain. But in the early days, they had to like many times make those parts themselves. So actually, they got a lot of expertise. The transition from a bicycle to a motorcycle, especially when they're getting a collaboration with Honda, was a relatively simple one for them. What was very important to Honda was the family values and the values. And that was really what Honda was after. And they got some great values with the Munjal. And it was a great partnership. So, I think to me, the biographies are the best.
I love biographies, by the way. Just love them. My last question to you. Uh, Talk to us about the Dakshana Foundation. I hope I'm pronouncing it right. Uh, I did I see it on your Twitter thread? You'd posted a letter Warren Buffett had sent about the annual report of Dakshana. Just talk to us for a few minutes about uh, your thoughts on giving, on Dakshana, what you're trying to achieve. Hopefully, it'll be an inspiration for some of us who are listening and viewing, and to maybe start that journey sooner than later.
Yeah, so I think the genesis of Dakshana really came from this notion that I read with Buffett, where he was talking about the fact that large inheritances do more harm than good. And so he was saying, I want to give my kids enough money for them to do anything they want, but not enough money to do nothing. Right. So what is that number? That's a kind of interesting question. But basically, large inheritances will end up really robbing the person of, leveraging their capabilities and so on. So what what we tried to do with my daughters was we gave them a sum that would give them a push in life. But it wasn't like it would be an IV drip for the whole life, you know. And Buffett says, if you're Jesse Owens' son, sprinter, he said, you're not going to become the best sprinter if you start 100-meter dashes at the 40-meter line. He said, it's okay to put your son at the 10-meter line, but not the 40-meter line. So I knew that basically with the compounding journey, we would end up with more money than we needed or could consume in a lifetime. So the only thing you can do if you're not going to give it to your gene pool is recycle back to society. And actually, giving money away is more difficult than making it. Choices are like poverty and education and healthcare and environment. All of these are very complicated problems. It's really tough nuts to crack. And so with Dakshana, what I wanted to do was I wanted to start early in life so that I got some experience. I wanted to take the arrows in the back and get better at giving. So Dakshana started when I was 42. And the idea was to give, I set up a formula, give away like 2% of my net worth every year. And it was really designed to be like a tuition bill, pay tuition so you learn. As it turned out, we got immediate traction and we got some great people in India. And Dakshina just took off, right? It has a great model. And it was a great model coupled with a great team. I did not have that much to do with it other than the funding and the direction. I mean, I'm not based in India, all the operations in India. It's a fairly large team now. And basically, what we are doing is we are identifying very bright but very poor 16 to 18-year-olds. And then we prep them for 1 or 2 years and they take the IIT or medical entrance exams. And the IITs have like a 1.4% admit rate. And we get 60 to 80% of the kids into IIT. So our admit rate is, it's almost 100%. And if I include the NIITs, is approaching 100%. So, and in medical, it's similar. Our hit rate is pretty high. And the thing is that we spend about $3,000 per kid. That's approximately what it costs us over 1 or 2 years for each kid. The transformation over 5 or 6 years in the family's well-being. So typically these kids are coming from families where the income is like, less than 6,000-7,000 rupees a month or less than $100 a month. And they're rural and quite poor. And, they'll graduate and be making 5, 7, 10 lakhs to start. And then it just keeps going up from there. So it was just a very no-brainer. So, if I see that there's a family making, let's say, 1 lakh a year, and I tell you, Rahul, I'll give you 5 lakhs, make their income 5 lakhs a year. Okay. Basically, it cannot be done. You could try various things. What we are doing is we are selecting families where the kid is very bright. So their income is low, but the raw horsepower is very high. And then we are harnessing that horsepower and connecting it to the global economy. And once we harness that and connect it, we can easily take the income to 5 or 10 lakhs. And so that engine works if you harness the brains. And, we are spending $3,000. The government spends on a subsidy basis 1.25 crore for each kid at IIT over 4 years. That's the tune of the government subsidy. The government is spending about north of like 20,000 crores on the IITs. So the basically 2 or 3 lakhs we spend is matched like 30 or 40 to 1 by the government, which is why we're able to lift. And what is happening with Dakshana is that we're able to redirect that money from the middle class to the poor. So it's actually utilizing those funds by the government in a better way.
Fascinating. It's always inspirational to hear, such about such efforts. So, congrats to you and to your team here for doing this. How many years have you been doing this now, Dakshana?
Dakshana started in 2007.
2007. Wow.
Yeah.
Oh, you
So
just celebrated 15 years.
yeah. It's almost 16 years. Yeah.
Wow.
Yeah. Time flies, and our oldest grads are in their 30s.
Wow.
Some are making like more than $500,000 a year. We have some that have quit IIT and done startups, and they've been funded by VCs. So a lot of good things going on.
Those reunions and all would be fantastic.
Yeah.
Yeah.
It's a great alum network. Yes.
Wonderful, wonderful. Many congrats once again. Since I have you, any one idea or thought you would want to leave our listeners and visitors with?
Well, I would say that the idea, an important idea to keep in mind is the magic of compounding. So, Einstein calls it the eighth wonder of the world. Compounding is the eighth wonder. So, if you think about compounding, there are really three factors that drive the result: starting capital, the annualized rate of return, and the length of the runway. So, if you have a very low rate of compounding and you have a very low amount of starting capital, but the runway is really long, you will again end up with astonishing results. So there's an interplay. We don't have the time to go into it, but there's an interplay between these three factors where modest amount of savings every month going into an SIP, being put into an index fund, and just done over a lifetime, and you're suddenly going to wake up and you're a wealthy guy. It didn't need to do a whole lot, didn't need to save a whole lot. It all just worked out. So in that case, it's the length of the runway. So starting early is really important. Having the savings rate is really important. And then the rest of it is just the magic of compounding. And you don't need to be a stock picker. You don't need to find an investment advisor. You just buy the mid cap or small cap index and you're done.
No, Monish, thank you very much for taking time out. We overshot our timeline, so thank you for accommodating us. It was wonderful, wonderful talking to you. Yeah? It's a dream come true.
Well, likewise, I had a lot of fun, and I look forward to the final clip when we release it. That'll be great.
Great. Thank you, Monish.
All right.
Pleasure.
Thank you. See you. Bye.
Thank you.